you a retail or institutional investor interested in Bitcoin mining companies? The Miner Mag brings you free data and analysis from all major NASDAQ-listed Bitcoin mining operations to know who stands out. Check out visualized metrics and data-dependent stories at theminermag.com.
Today's show is brought to you by Digital Shovel. Digital Shovel is a leading manufacturer of modular mining pods as well as PDUs and switchgears. Unlike many other competitors, their product is designed and manufactured in North America with a complete UL inspection on the entire unit, not just individual components. Additionally, Digital Shovel is one of the most vertically integrated manufacturers of over 75,000 square feet of sheet metal shop, SMT and wave solder PCB assembly, as well as final assembly all under one roof in Toronto, Canada. Their price point leads the industry when compared to products with rates as low as $69,000 per megawatt for a complete data center with smart PDUs and switchgears. To learn more, visit digitalshovel.com. Sam Callahan, welcome to the Mining Pod Bitcoin Stock Show. How you doing, brother?
Good, Colin. Thanks for having me on.
Yeah, I really appreciate you coming on, man. It's been a minute. Hope you are doing well. And we got to talk about this big old tweet thread you did about all the institutions that are holding our precious orange coin.
Yeah.
And I want to start with something that you just told me before we started recording. First of all, what inspired this? Second of all, how did you actually scrape all of this data?
I guess the first question is, why did I do this? It's really just because I had the question. Like, I wanted to know who was buying. It's really what we're talking about here is Bitcoin ETFs, first off, because these are 13F filings. So it's only US stocks or equity related investments that are included in these 13F filings. Now, these firms could be holding spot Bitcoin, but we just don't know that from the 13F disclosures. And so really this is Bitcoin ETFs, but I wanted to know who was buying them. And I wanted to know how much they were buying. And I wanted to know what their allocation size was. And really what I wanted to do now was basically collect it all. And this is from Q4 2024. And I wanted to follow it over the next quarters to see how it changes over time. And to do that, I first had to build out, the database. And so, there's probably smarter ways to do it, but I did it the old fashioned way, which was just sec.gov. And I just every single day. So there's a 45-day window of 13F filings where these large institutions, so that's financial institutions like RIAs, hedge funds, family offices, asset management firms of all different kinds, sovereign wealth funds. Anyone who holds more than $100 million in assets under management have to file these. And so their 45-day window after the end of the quarter, so that's January 1st to February 14th, every single day you get these things trickling in. And so every single day I went on sec.gov, looked up Bitcoin as the keyword, and I just manually went in there and then I calculated what the position size was throughout each of the filings, which the only reason it was complicated was because each of these funds or firms or whatever, they have allocations to all these different ETFs. And so I had to add them all up each time because they would have, some would hold a portion in the Fidelity ETF, BlackRock ETF, Grayscale ETF, whatever it was. And, I wondered why, because they're really similar in terms of their fee structures. And honestly, I think it's just because they like to maintain relationships with each of these, these firms, these issuers. So they say, hey, I'll buy a little bit of your ETF and I'll buy a little bit of your ETF. But it made my job a little bit harder because I'd add it all up. And then sometimes it was, one of the things 13F filings include is stocks, preferred stocks, US preferred stocks, REITs, ETFs, and options. But they're only long positions, but you could be long a put option. And so then you have to net it because some of these firms were actually short Bitcoin. And so I had to go in there, even though they had exposure, they were technically short Bitcoin. So I had to filter all those out. And so long story short, there was, from my count, there could have been human error here. From my count, there was 1,573 institutions with long exposure to the Bitcoin ETF. So
it's a gargantuan number. I mean, did you go through for each and every one of those for 1,500 companies and pull all of this data? Or did you kind of just, for your sanity, say, these are the bigger ones, I'm going to focus on these?
No, that's not how I work. I did every single one. I want to know every single one.
This is giving me heart palpitations as someone who has scoured Edgar for, financial statements and earnings reports from these miners, or from public miners specifically, that's so much data to go through.
Well, there was so much look, when I started doing this too, I was like, once you start going, you're like, okay, like I did it for a couple of days and it was kind of like a lot, but then I was like, all right, well, now I started, I had to just keep going. So by like the third week, I was a little bit, there's also there's probably smarter ways to do it. So after I did this whole thread, somebody linked me to this site that this guy made that kind of tracks this stuff. And I was like, oh, well, this would have been nice to know beforehand, but it didn't include some of the details that I wanted from just doing it more granularly. But 13f.timechainindex.com, that's a good resource that I wish I knew about before.
Well, yeah, you got to get the bona fides though, right? Like now you've been in the trenches, you have the experience and you have the pain of going through this by yourself. So you can kind of brag about that, right?
Yeah. And I learned a little bit of things. It's kind of fun. I think the thread got, a little bit of virality because, some of these details were interesting.
Oh yeah, they absolutely were. And that's what I wanted to ask you next. What surprised you most going through this?
I mean, what surprised me most was how small the allocation sizes are still to the, I said the median was 0.13%. And I, before I even said that, I kind of clarified because people talk about 13F filings and they assume that it's the entire fund's portfolio, but it doesn't include things like bonds, real estate, direct Bitcoin exposure, futures, short positions. So it gives an incomplete picture of the entire fund's portfolio, assuming that they invest across a broad range of asset classes. And then it doesn't include, you don't know if a long position is actually a hedge for another short position somewhere else that we don't know about. And despite that, so it's still only 0.13%. And so, which means that that's only for the equity portion of these funds, which means it's probably even smaller than that. And, it just shows how early we are in terms of the institutional adoption of Bitcoin, which may be quite bullish. And, I brought up the sovereign wealth fund. The Abu Dhabi sovereign wealth fund was probably the biggest filing. I mean, sovereign wealth funds manage a ton of money. And they also have very long time horizons. So they're kind of perfect for Bitcoin. It's not like a hedge fund trading. It's typically they hold things for a really long period of time and they have a lot of money. So the Abu Dhabi Wealth Fund was a big disclosure and they had $473 million worth of exposure. It was their second largest position in their filing. But, that filing only had $20 billion in it because that's how much their US equity exposure is, when really they manage $302 billion. So that Bitcoin position is not 2% for them. It's actually 0.14%. So I bring that up because it's the median 0.13% position size for these 13F filings for Bitcoin with these institutions is tiny. And so BlackRock recently came out, they ran the numbers, Bitcoiners have been talking about this for a long time. A 1 to 5% allocation is completely reasonable for any kind of investor, really, because it actually improves the returns of a portfolio while reducing the risk because Bitcoin's uncorrelated. And so BlackRock recently recommended 1 to 2%, and these institutions only have 0.13%. So, I mean, if they just listen to BlackRock, we're talking they should 10x or 20x their position size, and that's a significant more inflows that could be coming down the coming quarters. So broadly, that was kind of the most surprising finding. And that's really why I dug into this. I wanted to answer that question. What's their position size? And it was small. It was tiny.
Do you have any kind of touchstone for how that relates to maybe other commodity allocations or investments, right? What should we expect from some of these funds to have gold ETF exposure? I doubt very many of them are holding oil ETFs or anything like that. But do you have a general sense of where that stands compared to other allocation percentages for other assets?
I mean, not specifically, but I know that it's minuscule compared to their equity and fixed income allocations. So alternative assets broadly is a broad subject, which I would put Bitcoin, gold, commodities into, real estate. It's a smaller percentage. And in gold, I mean, I remember this chart going around. I mean, it was something ridiculous, less than 1% of financial advisors had exposure to gold. This was last year or something like that. Don't quote me on that number, but it was small, very, very small. And so I think it goes down to this factor where, over the last 20 years, in terms of constructing a portfolio, it's been mostly bonds and equities. But when you're in a period of increased inflationary pressures, you have to consider diversifying into other alternative assets, because bonds and stocks start to move together in inflationary times. And that's when we saw in 2022, when, bonds and stocks had their worst year in it was something crazy, like since the Civil War or something. But that's really what happens, is because, bonds lose in inflationary environments in real terms. And then equities also tend to suffer. And so they no longer kind of provide that diversification. And so you have to go to alternatives. And so I think, to answer your question, a very small percent have allocations to gold and these alternative assets, but that's growing, and that trend has to grow because, in more broadly, my macro thesis is we're headed into a more inflationary environment, and these money managers have to begin to understand that we're in a regime change, and they have to think about portfolios differently.
Do you think that's what's going on with a lot of these allocations? Like, how much of this, and you kind of break this down with some of the funds that you talk about, right? Like there's Paul Tudor Jones's fund in there.
Yeah.
There are a bunch of other fund managers who have been pretty bullish on Bitcoin for a few years, right? Yeah. How much of this, and this is kind of like a vibes question, because there's no way you can divine this from the 13 Fs, but how much of this is just riding the wave after the ETF? And how much of this do you think is actually forward-looking application for when the money printer gets kicked back on?
Well, I think I tried to highlight some funds that I just perceived as maybe more likely to be long-term holders. And, Paul Tudor Jones has been on television multiple times, and he wrote a piece, in terms of hedging against currency debasement or inflation or rising geopolitical tensions. Bitcoin is a good allocation to make. And so for him, I'm like, okay, Paul Tudor Jones seems to get it. Same thing with Brevin Howard. They believe in Bitcoin as a technological disruptor, and they've been holding Bitcoin for a long time, but now it's their second largest position. And that's notable because they're a huge, huge macro fund. And so Alan Howard, I included a quote from him.
This is great. I'm glad that you're mentioning this.
Yeah, he did it in Yeah, I did it in 2022 when Bitcoin was down 50%. It just shows that these people are holders, and their second largest position, $1.4 billion worth, is a lot. And Horizon Kinetics is a firm that I really respect, because I don't think enough people know about Murray Stahl, and I read his market commentary all the time, and I think he's brilliant. But I shared their commentary letter, and they specifically talk about how they're not rebalancing their Bitcoin position because they think it's still overvalued or undervalued. They want to benefit from the compounding, and they think it's going to, I think they say escape velocity. They're waiting for escape velocity or something like that.
Yeah, I've got it up here. And this is the January 2025 Q4 investor letter. Example, long-time rising. If we sold the Bitcoin Trust position after it had tripled, woohoo, it would have been a 1.5% portfolio position. What possible impact could that have made on your life? But at this time last year, the Bitcoin positions had become maybe 8% of our portfolio. If they were to double or triple from there, they could really enhance the value of the portfolio in a meaningful way. As it happened, Bitcoin is up 135% this year. This is a long way of saying we are awaiting, and in other positions as well, for compounding to truly work to achieve, as another client put it, escape velocity.
Yeah. So and Horizon Kinetics, they have other commentary on Bitcoin. They really seem to understand, what it is and why it's important. And so for those types of funds, I do think it's more being seen as an allocation to hedge against currency debasement, as well as rising geopolitical tensions, trade wars, which is fair, right? I think Bitcoin is a great way to play that world. It's part of the reasons why I'm so bullish on it. I think everybody has a big problem, which is that central banks and governments keep debasing the currencies, and given Bitcoin fixed supply, I think people are starting to wake up to that fact. And so those funds that I mentioned, I think they are holding Bitcoin for a more long-term position. And you're just starting to see pension funds, endowments. I mentioned Bracebridge, and part of the reasons why I mentioned those funds too. I really respect some of the money managers that are doing, they have a really good track records of being very, the top performers. and they're the ones allocating to Bitcoin in big ways, way above the 0.13% median allocation. These are like 5%, 10%, 16%. This is the largest positions, and they're some of the best money managers in the world. Bracebridge is another firm that I learned about, led by Nancy Zimmerman, who's brilliant. She's the most wealthy female hedge fund manager in the world, manages $12 billion on the board of trustees, Brown University, manages portions of Princeton and Yale's endowments. And those are two of the best performing endowments of the last 20 years. And so these are some of the smartest money managers that are allocating to Bitcoin. And they're kind of starting to understand why. And it's because of diversification benefits and performance enhancement. And then as a hedge against maybe rising geopolitical tensions. Ray Dalio puts it like owning non-government money in a world where the governments are continuing to weaponize their currencies against each other and then printing money, obviously, and debasing it. So, yeah, in some of these other firms, I just, they make a lot of noise in terms of like the banks holding it, the big banks and the big Millennium, Citadel, Point72, some of these huge famous quant hedge funds, like they make about headlines, but I'm just not as interested in those because I don't think they're holding for the long term.
Well, you're saying that because they're basically just using it for trading or liquidity purposes. I mean, this is something like you mentioned Jane Street in this as well, I think, right? And so what are they doing with it? They're just short-term trading it, or they're just putting it on their books so that they can provide services for people who want to trade it or buy it?
Yeah, exactly. They're market making firms and quant funds. I mean, they're just like basically net neutral Bitcoin, providing liquidity, playing both sides of the market. And they're huge. They're huge firms. So they hold like $2.5 billion worth of the ETFs. But they're just doing arbitrage opportunities, and they're not like net long Bitcoin. They're just kind of like, they don't care. What I mentioned is like, they don't care what the ticker is. They don't care if it's Bitcoin or IBIT, GE, TLT. Like, they literally do not care what the tickers are. They'll trade everything, and they're just looking for arbitrage opportunities. And they're good for the market because they provide liquidity and they, tighten spreads. And, it's a good thing that they're trading around it. But when I see social media say like Citadel owns $2 billion, one of them was Renaissance Technologies, which is Jim Simon's famous quant fund. It made all this noise a couple quarters ago. They own hundreds of millions of dollars worth of IBIT. And I was like, that's not, they're a quant fund. Like, their algo is just buying it. And I think their average hold time is like 24 hours, like for positions. Like, they just like high frequency trading, in and out, in and out, in and out. So those funds are just not as interesting to me. And I think just providing that nuance is helpful.
It reminds me of when the headlines would hit last cycle of hedge funds longing Bitcoin, because they're just basically like factoring it into whatever their positions are at this point. And like, they're not actually, they're not going to hold these things long term. They're just either like covering a position somewhere else, or they just see an opportunity for a short-term trade.
Yeah.
That was like the equivalent of that last cycle, and people would tweet that out as like bullish, bullish fodder.
Yeah. And like, honestly, some of the ones that I mentioned, maybe they are doing that. Like, it's impossible for me to know, which is why I like mentioned in the beginning that like a long position could be a short position elsewhere that you just don't know about. I just kind of like did some due diligence and tried to like gauge whether that's the case, but there is speculation there. And that's why it's just going to be fun to track this over the coming quarters. If they dump it, then I'm like, all right, they were just doing some kind of trade. But I tried to guess like which ones were and which ones weren't. And, the big banks, that's a whole nother thing where you see like Goldman Sachs owns all this and Morgan Stanley. They're what they call authorized participants for these ETFs. So they are responsible for creating and redeeming new ETF shares, working with the different issuers, as well as market making activities to provide liquidity. And so they're always going to keep a little bit of these ETFs on their books to do that. It doesn't mean that they're long Bitcoin.
Can you explain that to me a little bit more? Because I'm not really sure I fully understand what the purpose of that is. I thought that, when BlackRock issues ETFs, for IBIT, or issues new, notes for IBIT. They're buying the Bitcoin on the back end, and then they're probably custodying it with Coinbase or something like that. And I thought BlackRock would be in charge of issuing and redeeming those. Did the banks also have a hand in this? Or are they kind of like the B team?
It's all about like how the ETFs work, where they have to keep the ETFs equal to the NAV of the underlying Bitcoin. So they respond every day to the demand for the ETF shares. And then they had to make sure that it's kept 1-to-1 with the underlying Bitcoin. So that's the big difference between Grayscale, which works as a closed-end trust. You could have these big discounts and premiums to the underlying. That's why ETFs are a better product, because they always stay 1-to-1. But in order to do that, they work with other banks and other participants to basically work with liquidity providers to make sure they're keeping the Bitcoin and shares at the same level. And that takes redeeming the shares or creating the shares based off, it's basically arbitraging the differences between the two. And so these issuers work with different banks they're called authorized participants for these issuers to basically arbitrage out the shares to the underlying Bitcoin to make sure it stays at 1. And so it's not really the job of the issuer to do that. They work with the different big banks and big financial institutions like the Jane Streets of the world, JP Morgan Chase, really a lot of these work as authorized participants. They all benefits because they make a little bit of money to arbitrage, like when they're redeeming shares, creating shares to keep that ETF in line. And so that's considered like I hope that makes sense, but that's considered like a approved crypto asset activity by the regulators that these banks could do, which is just like making sure that the ETFs are functioning properly as they should. And they make a little bit of money when they do the arbitrages, but they can't own it themselves on their balance sheet. And that's kind of what I highlighted because of
the banks can't hold it.
Yeah, the Fed. So like people are focused on SAB 121, right? So SAB 121 is the rule from the SEC that said that banks can't custody Bitcoin on behalf of clients. Okay, so they can't hold it on behalf of clients, but now that's been rescinded recently. So now they can. But the Fed also has a policy in place from January 2023 that says the Fed can't, or the banks can't hold Bitcoin as principal on their balance sheet. So they can't hold it themselves. Like if they wanted to, if Goldman Sachs wanted to be like MicroStrategy and like adopt Bitcoin as a treasury asset, they can't right now. The Fed prevents them from doing that, even if SAB 121 has been rescinded. If they wanted to build out like a payments infrastructure using Lightning or Bitcoin, they probably can't do that because they can't hold Bitcoin as principal because of this Fed policy. And so that's why when you see these ETF holdings from these banks, it doesn't mean that they're holding it themselves, because they literally can't right now because of this Fed policy statement from January 2023. Now that could change. We're in a very rapidly changing regulatory environment. So I said, keep an eye on this. And it's something to watch closely. This is another reason why I did this, because I want to watch these bank holdings in the coming quarters. If we see like a rapid increase, as well if the Fed starts to get in line with like the SEC, now that we have there's a lot of pressure from the regulators, as well as there's a lot of new leadership that's very pro crypto, pro Bitcoin. So I think that's going to change. And so right now, though, it's just not as interesting to me that these big banks have the ETF holdings.
Big players in Bitcoin mining demand stability, regulation, and trust. That's why NiceHash has moved its headquarters to Switzerland, a country known for its strong regulatory framework and for keeping its cheese locked in a safe. As one of the most regulated mining platforms in the industry, NiceHash provides institutional miners with a secure, compliant, and transparent solution to manage and maximize their mining output, delivering the reliability and performance expected from the best mining tools, along with firmware, monitoring software, and other essential mining tools. Contact a NiceHash representative today to learn why the top Bitcoin miners are making the switch to NiceHash. You can find out more info in today's show notes. And when you contact them, let them know the Mining Pod sent you.
So what are some of the more interesting holders in your eyes? I mean, you kind of covered some of them, but because I'm also probing here for some of the use cases like the pensions or the endowments, right? That most people don't usually think of.
Yeah, those are exciting. I mean, the pension funds, obviously, the pension funds, there's a big problem with pension funds in our country, right? A lot of them are underfunded.
You have this great chart here.
Yeah. So
the funded ratios by state.
Yeah. And you notice like some of these ones that are really in trouble, like Illinois, Kentucky. I mean, these are less than 60% funded. That's a problem. That basically means like in the coming future decades, they have all these retirees and they don't have enough funds to pay them right now unless they really jack up their performance. And part of this was because of, just poor asset allocation. Part of it was because of very low interest rates for like a decade, because a lot of these pensions rely on fixed income because they want to invest in like quote unquote safe assets. But when bonds were paying like nothing, they really suffered these pensions. So they started to take on leverage and started getting riskier stuff. And, a lot of them could probably use an asset that compounds like at 50% a year in the last 5 years. That'd be a good asset. And so they also have very long time horizons. And so that's another thing why pensions, they have a ton of money, trillions of dollars, and they have long time horizons. And so even a small allocation for a pension, these are likely long-term investors, and they could really benefit because obviously we know that Bitcoin short-term is volatile, but over long periods of time, it outperforms. And so these pension funds are really interesting. And we just seen the first, like the Wisconsin and then Michigan with a smaller position than Wisconsin. But the story is that they're increasing their allocation size each quarter. And that's a good thing. And so that trend of pensions, and this is public pensions. There's also private pensions and things like that. But it's a really important trend. And then endowments are the same thing. So endowments, they're a little bit even more flexible than pensions. Pensions are tricky because you basically have like payouts that you need to service throughout the next 10 years, 20 years. When more retirees, you have to pay them out every year. So there's a lot of math that takes place, which is why they like bonds, because it's like 10-year bond, 20-year bond. It pays out a certain time. They can do that math. Endowments don't really have that as much, but they have really long time horizons.
You just employ it when you want to.
Yeah, and they have
like the university just decides to use it when they want.
Yeah, they have like some costs with the university every year that they have to fund, but in general, these endowments have really long time horizons and a lot less restrictive investment mandates, so they can do more. They can really allocate wherever they want, basically. And so these endowments have been investing in Bitcoin indirectly for a long time. I know some of these Ivy League Bitcoin endowments have invested in like Bitcoin focused hedge funds. So that's the less efficient way to do it, because you basically have to pay a fee to these hedge fund managers just to like buy Bitcoin. It's like not the ideal way to do that. But the reason why they were doing that was because there wasn't better options. The ETFs didn't exist. And so you're starting to see these endowments start to get into it. Now, a lot of these endowments they also trust hedge funds, large managers to manage money for them. And so that's like what the Bracebridge that I mentioned, she manages portions of Yale and Princeton, and then her single largest holding is Bitcoin ETFs. And so that's how these ETFs, these endowments have like exposure, because they basically trust different money managers to manage the funds on their behalf because they're freaking huge. And so endowments are also like a more like long-term big capital pool. That is really interesting to see that trend start to develop. And the Ivy League ones are the best ones. I mean, they've been the best performance. They have a ton of money, obviously, and they're run by really smart people. And so that trend's just getting started. And then the sovereign wealth fund is like, that's big news. So it's similar idea. Big pool capital, very long time horizon. Can invest in whatever they want. And we just got the first disclosure of a major sovereign wealth fund, the Abu Dhabi one, investing. So those are the three that are really interesting to me.
Are there any others that you would be kind of looking out for in the future in terms of other allocations or exposure from other sectors of the investing community?
One thing that I thought was really interesting that I found was the Fortress Investment Group, which is like a large private equity group that turned into like a more broad, full service asset management. But it's the fact that I found out that they were recently sold to the Abu Dhabi Sovereign Wealth Fund. So like, I didn't know that, but it was really interesting finding, because I'm like, oh, okay, their fourth largest position is Bitcoin. And it's actually just the Abu Dhabi sovereign wealth fund that's the majority owner. So it's just more Bitcoin exposure for the UAE. So I thought that was really interesting. But to answer your question, I'm really interested in financial advisors, because financial advisors manage a lot of money on behalf of people. And there's a lot of older generations that still trust their financial advisors to make investment decisions for them. It's been very slow for them to start to get their heads around Bitcoin and why it's not risky. And it's kind of like a one-to-many orange pill, where if you orange pill a financial advisor, he's going to tell all his clients and say, hey, this is actually a good idea. Maybe he orange pills half of them. And then they say, it's like a tree, right? It just kind of branches out. So I'm really interested in tracking like major financial advisory firms. And one of them that I mentioned was Crescent. And the reason is because they're like one of the top ranked largest ones. And it's been interesting to see how Bitcoin ETFs is now like a top 30 position. It's increasing every quarter. And it's a good gauge of like the financial advisory world. And I think from all this research, it just shows how early we are, because only a tiny, tiny portion of these financial advisor firms are allocating to Bitcoin at all. And when they do, it's like a very, very, very small allocation size. And we know from the data that it actually should be higher. And I think both of us know that when people learn about Bitcoin, the more you learn about Bitcoin, the greater your allocation size.
Certainly for us, at least, though, Sam.
Yeah. Maybe for us. So like financial advisory firms, it is something, and the family offices as well. They're a little bit more, there's a lot of money there. There's just like trillions and trillions of dollars.
Right.
Like, you know what I mean? It's just like, we're so early, and that's kind of, it's like a meme, obviously, but how early we are, it's pretty incredible. Like I mentioned that only 19% of all the ETF or the 13F filings had any kind of long exposure. And then that long exposure on average was 0.31%. The median was 0.13%. That's a fraction of a fraction, right? Of the total filings. And so it's extremely bullish. Extremely bullish.
Bull fuel. The advisor thing is a good point, because even a company like Fidelity that has been uber bullish on Bitcoin for a while, right? It's a good reminder. Fidelity has some absurd number of employees. The last time I checked, it like kind of blew my mind. It was in the tens of thousands. And that's to me a good reminder of going back to how early we are. Even with that, like that doesn't necessarily sway the mind of, Craig, whoever, your local advisor here in your hometown, right? Who's going to tell your boomer dad to, buy, index funds or, fixed income and things like that now that interest rates are up. No, it certainly helps to have the parent organization on board with it, but it almost has to, it's like a slow trickle down through the ranks, right? Because back to what you were saying, my father-in-law uses Edward Jones, and he treats everything his financial advisor says like gold. I mean, like he'll just basically say, yeah, that sounds good. Send him the money and do whatever. And I feel like that is perhaps in terms of the retail side of things, that would be the biggest boost at this point on the retail side. Like most of what we're looking at here is like almost completely institutional. There might still be, some people holding ETFs through some of these institutions that are, smaller allocators. But my point in that being, it's like the financial advisor side of things would actually be something that could ignite more retail interest in Bitcoin.
Yeah, like I think it's a great point. I've always said the ETFs were kind of more geared towards these institutional investors anyway, because they just are restricted from buying spot Bitcoin. Like personally, I think you should hold your own keys and all that stuff, but there's trade-offs, right? And the convenience, and also it fits into their mandates and it fits into their existing platforms, just makes it very easy. And they also can get fees from it. That's a big difference. Right. And so I think even today, I mentioned Morgan Stanley became like the first major bank to allow its financial advisors to pitch Bitcoin ETFs to their clients. A lot of them can't do that yet. They have to either they can't do it at all, or they have to wait for the client to bring it up to them, and then they can advise them on it. They can't actively recommend it. But Morgan Stanley changed that back in last August. But eventually they'll all kind of start to do that. A lot of them don't even have access to them yet. So they use these platforms, and only a handful have allowed Bitcoin ETFs so far. Cetera is one example, is one of these major turnkey platforms that these financial advisors use. They're tech platforms, and they allow Bitcoin ETFs, but they're just one example. All of them definitely don't. And so the infrastructure is still getting built out to allow these financial advisors access. I recently did a in-person event and was reaching out to some of these major financial advisory firms. I won't say which one, but we were reaching out and we had good intros from people. And the person that we know was like, that guy wouldn't ghost you. I wonder why he didn't, respond to you. I'm going to reach out. So he called him. And then that guy, one of these advisors said oh, I never got that email. And then we found out that if the word Bitcoin is in the email, it's completely censored and they don't get it.
So that's crazy.
So that's where we are right now with some of these firms. They're still censoring emails with the word Bitcoin in them. And so all that's to say, there's still a lot of barriers in place for these financial advisors to get access to the Bitcoin ETFs. And so as those barriers fall in this new, more favorable regulatory environment, it's obviously going to help things. And we've been, the Bitcoin ETFs have been wildly successful in terms of the AUM they've gathered despite all these, barriers, which is crazy, right? So, yeah, it just kind of makes you bullish.
That filter honestly contextualizes the "we're still early" comments for me, is because I look at a $2 trillion market cap and sometimes I'm like, doesn't seem so early anymore.
Yeah,
but it does seem that there's still bias that hangs around with some of these financial institutions.
Well, I was at the dinner. I sat down at a bar and sit next to these two guys, and they're kind of speaking loudly, and they're talking about Bitcoin, and they're financial advisors from one of these big firms, and they're just talking about Bitcoin, and we're overhearing them, and it's just kind of like one of those situations where you're just kind of like, should I say something? Well, I'm not going to invest because quantum is going to break it. I'm going to do this, love this. I don't know, MicroStrategy, Michael Saylor. And so we started talking to them, and they managed a lot of money for a lot of old individuals. And they still weren't on board, but we tried to answer their questions and do these things. And, I think they walked away with a little bit more open-mindedness towards it. But you could just hear from the conversation before we jumped in, how much education still needs to happen.
Right.
And especially maybe just time to get them more comfortable to allocate their clients. They owned it themselves, which is interesting, but they still didn't feel comfortable allocating their clients to it.
I kind of sympathize with that, and we're getting a little bit off the topic at hand, but I think this it bears mentioning. I kind of have stopped trying to get family members involved and friends, just because there have been times where I have been you should buy, and then it's the wrong time, and then Bitcoin gets cut in half, right? And then it's also just exhausting because sometimes they just don't listen, and it's okay. It's that meme, right, where it's honey, do you want to come down and talk to everyone about your magical internet money? It's the dude in the attic, and it's Thanksgiving dinner.
Yeah, he's looking down.
Yeah, exactly. I can kind of sympathize that because when it's your money, if you lose it, you only have yourself to blame. And then if you tell someone else to do it and then they lose it, because even if it goes down and then goes up, if they sell it when it's down, they're still going to be mad at you, even if you told them to just put it away and not think about it for 10 years.
Yeah, no, I get it. I mean, at this point, it's all your closest friends and family, they probably know you're the Bitcoin guy. If they wanted to, if they have questions, they'd reach out yourself. You don't have to
you carry your proselytize, get your robe on and get your ancient tomes and and do some Gregorian chanting about the white paper or whatever.
Yeah, my favorite is like I think American Hodl is some like the best videos, but he did like one of his like selfie videos where he's like, "Hey, it's me, your best friend who you've told to buy Bitcoin forever. So yeah, I know you said that, but like, what about this XRP thing?" You're just like, oh, I guess that's so spot on.
It really is. The XRP marketing strategy has been so sticky. I met this dude.
I don't understand it, but
I met this guy in New Mexico, and my wife and I were there for a wedding. This dude grows his own pot, like thinks the moon landing is fake, like bullish on RFK during the last election cycle, just like totally coded to be into, non-state money, decentralized digital currency, right? And we're talking about it, and he goes, yeah, I've bought a lot of XRP just because I think there might be something there with like interbank transfers. And it was like a glitch in the matrix or a glitch in his reasoning. It's like, wait a second, dude, you believe like a lot of these crazy conspiracies that a lot of my Bitcoiners friend believe, but you want the banker's coin? It just made no sense to me.
They have a great story. I mean, I have to say it. Like, it's stuck around, and like I don't understand how some of these people even come across it. What marketing avenues are coming. Like, I've had people reach out that have no business. They just don't care about like investing or markets or anything. But they're like, "Hey, have you heard about this XRP thing?" I was like,
"Right.
Wait, how did you hear about this? Like, where did you hear about this? Like, how do you, And I think like." Yeah, there's not much to say about it. They have a really good story. I think it's difficult still to understand like why Bitcoin is different than the other ones. And
100%. And that's what goes back to the financial advisor stuff too, right? Like I can sympathize with not being able to have an intelligent conversation with some very elderly people who are relying on you for their retirement to explain why you're putting money into something that they can't touch. They have no idea what it is. That's not backed by a productive asset, et cetera. All of these old conceptions for what makes up an investment are just completely shattered by something like Bitcoin, right?
In the competitive world of Bitcoin mining, one name stands out: CleanSpark, America's Bitcoin miner. At CleanSpark, efficiency isn't just a goal, it's our standard. Our sophisticated facilities are built and led by expert teams who care about Bitcoin and the communities we work in. Scale, we've mastered it. Our large-scale operations have set us apart in the industry as examples of community-oriented building. Our track record speaks for itself. We navigate the complexities of the new economy with precision and with skill, continuously achieving operational milestones. Curious about how we do it? We invite you to discover the story behind CleanSpark's success at cleanspark.com.
Well, just last question. Anything else that we didn't touch on within your research that you thought bared mentioning here, or?
Well, no, I think that pretty much covered it. I think it's just important to understand that even like some of the ones that I mentioned, that could be the case that they're not really long Bitcoin. I think I tried to do the due diligence to kind of cipher out who held a lot of Bitcoin in terms of their position size and who is likely to be long-term holders, but I could be wrong, which is why I'm going to track it over the coming quarters. And it's going to be interesting to see how it changes over time. And these financial advisors, these banks, as the regulatory environment changes, I mean, it's going to be very, very fascinating to see how much inflows goes into these ETFs. The other thing is that we don't know how much they could hold a bunch of spot Bitcoin. Abu Dhabi's sovereign wealth fund could have a whole horde of spot Bitcoin already. We just don't know. So just keep that in mind. There's a lot of there's a few assumptions with 13F filings, and I think it's important to have that like kind of nuance.
And that's one of the hardest things to do, I think, when you're doing research like this. I've often found myself in a corner looking at SEC filings and having to make assumptions when I'm refining the data, and I always kind of get a little nervous because it's like, oh, this could be wrong. But I think that nuance was really important about the difference between the quant funds, right? and the market makers and the ones who seem to be really actually holding it as long-term positions or a part of a portfolio for something like an endowment or pension. I think that
I think that's why you're one of the better researchers out there, man. You got to have that mindset. Like you never want to like give off the wrong signal or something like that. So always got to think about those assumptions. The other thing I didn't look into is just like the MicroStrategy thing, like cause I was like, oh, man, I just don't feel like doing all the work. Like that, like adding MicroStrategy to it or the miners or Coinbase. There were certainly some major positions of MicroStrategy and Coinbase throughout all these things. I think Julian Farr, who's a friend of mine, he did some good work at looking at MicroStrategy, which institutional investors have them, but you can kind of see it as a proxy, right? Leverage proxy of Bitcoin. So that's another thing to keep in mind, which I just didn't dig in further enough.
I mean, yeah, you had, 1,500 filings to go through. I think that would be an interesting follow-up to this. And what you also might find that I was not surprised when I was looking at your research was Jericho came up, for instance, and we did a piece for the Mining Pod this past week on institutional holdings of Bitcoin miners. And sure enough, Jericho has one of the larger positions.
Oh, not surprising, but very interesting to me.
Yeah, right. So there's probably a lot of overlap, but it would be really interesting to see who's holding big bags of MicroStrategy. But that's for another day. Sam Callahan.
Just real quick. Would you consider like miners still just like leverage Bitcoin position, if you will?
That's a great question. And we're going to know more about that over, I think, the coming halving epoch, because a few things happened when the ETF launched. You actually did see the beta between Bitcoin and mining stocks uncouple a little bit. Like last year was actually the worst year for mining stock correlations to Bitcoin since we've had major miners crop up, back in, you could argue like 2020 was probably the first cycle where they really became important. I mean, you had Riot and Marathon and Hut 8 and I believe Hive back in 2018, but it was still such a small trade. And so you're already starting to see that. I do think, though, there is an argument to be made that just like with gold miners and silver miners, uranium, literally any mineral or commodity producer, like when the price of the commodity goes up, then their stock price should reflect that because you expect them to have greater cash flows in the future, right? I do think that what the ETF has forced investors to do, though, to your point, is you can no longer just YOLO into a Bitcoin mining stock and you treat it as a proxy to Bitcoin, because now there are much better proxies. You could even argue if you didn't even want to hold the ETF, you should just be holding Coinbase instead of a Bitcoin miner, because that's a much better, a much better form of exposure in terms of the actual underlying asset. So I think what you're starting to see is investors are really starting to price in fundamental more. And miners have never really been good long-term holds. You always want to just trade them in and out of cycles. But I think over the next halving epoch, you'll actually see the wheat be separated from the chaff, so to speak. And potentially some miners will differentiate themselves as actual, operators that you would maybe want to hold for the long term. Because truth be told, like most of the mining, the public miners are just, I don't want to say that they're not good operators, but they haven't operated in the way that you would want them to if you were allocating to a stock for a long-term investment. It's like they never want to sell their Bitcoin, which was great when there weren't ETFs to buy or MicroStrategy. Now that's kind of a less attractive play, having a massive hoard of Bitcoin. They constantly dilute their stock because they don't sell their Bitcoin. So they need that to actually fund operations and expansion. They very rarely actually generate positive returns, right? So I think that's why a lot of them too have been pivoting towards HPC and AI. Like Bitcoin mining is brutal. I really don't think that it makes sense for there to be so many public Bitcoin miners, just for the simple fact that it's a really tough business and you have all of these other reporting requirements and you have all of this other overhead as a public company that you have to, bake into your SG&A and your cost of revenue and stuff like that. And with HPC and AI, it's like if you can actually make that work, then the cap for that is is probably much higher. There's no difficulty adjustment in high performance computing, right? So like, there's no, your hash price, right, for Bitcoin mining revenue won't get compressed just because more people are coming onto the network. And that's kind of a long-winded answer, but the last thing I'll say, I also think the market is just exhausted. There's like 25 public miners at this point.
That's a lot.
It is. And in 2020 and 2021, a lot of them came onto the scene. It was still kind of a hot trade. Now you're not really that special if you're a public Bitcoin miner, right? Because there are so many peers that people can invest in. So,
yeah, the market's changed.
Yeah,
pretty substantially.
100%. And you got to wonder the same thing with like the master trade, micro. I always call it master because of the stock ticker, the strategy trade, right? Like
strategy, yeah.
Metaplan is doing it now. Strategy obviously made its name doing it. Like, how much appetite do investors have for that? I don't know.
Yeah, that's a really interesting question, because it's you're starting to see these copycats, and I go back and forth because if I'm interested in investing in a Bitcoin treasury company, it's like, why not invest in strategy? The largest, they have the best access to capital markets to keep doing the strategy. It's interesting, but then I go back and forth because I'm like, well, if you're in different or small company and you're not growing, and then you're in this like different sector, if I'm an investor in that sector, I want to invest in the company that has Bitcoin on their balance sheet, because when it comes down to it, the Bitcoin is probably going to perform pretty well over long periods of time, and it's going to capitalize the business. So relative to competitors, I would think those companies would outperform if they adopt a Bitcoin treasury strategy, if they manage it appropriately and things like that. But like in terms of the market, I don't know. I think we're in this period where you can just like announce a Bitcoin treasury strategy and the market like pops your stock. And, I don't know how long that's going to take, but I do think the companies that adopt a Bitcoin treasury strategy over the long term are going to be in a healthier financial position than ones that don't. So it's a fascinating, like it's happening right now, that trend. Like you saw GameStop.
That's crazy. If
I don't know,
happens.
it's speculation for sure, but like,
yeah. I mean, you could see it happen though, right? It seems very fitting. This is a company that
cash too. It's crazy how much Eric Semler Scientific is a perfect example. And I brought the Jericho Capital. That was one of the things. Like Josh Resnick runs Jericho, who owns a lot of the ETFs, and you mentioned has a big miner position. He worked with Eric Semler like in his early days, which was really a little bit of a fun tidbit. But like Eric Semler like followed in his footstep, and now he's identifying potential zombie companies that would be good candidates to adopt a Bitcoin treasury strategy. So he identified Zoom, who has $7.7 billion in cash.
Zoom,
like, Zoom Communications.
Seriously?
Coursera is the one that he's identifying these like cash rich, poor growth, sluggish stock performance companies that would benefit from adopting a Bitcoin treasury. It's just crazy how much cash these things have. Eric Yakes, I think, is a mutual friend of ours. He put out a great report recently. Big report, 150 pages. Congrats, Eric. But he found that like if I get this right, the top 10 publicly traded cash reserves, like those companies, if they put in 15% of their cash flows, just 15%, it would be more than the entire AUM of the ETFs up until this point. And so the amount of cash that these public companies have is just freaking crazy. And so even like GameStop, I said like GameStop has $4.6 billion in cash. If they put half of that into Bitcoin, they would already be the third largest publicly traded Bitcoin treasury company. Like it would be Strategy, Mara, GameStop.
That's wild.
Just because they're so much bigger. Yeah, there's it's a wild it's a wild dynamic, and I think we're in the early stages of that trend too, which is it's just corporate adoption, institutional adoption. The investor base of Bitcoin is changing forever,
rapidly, whether people like it or not. And a lot of people,
whether people like it or not, Bitcoin's for everyone. So,
well, on that note, Sam Callahan, thank you so much, man. Where can people find you? Where can people find more of your writing and research?
Yeah, thanks for having me. Always appreciate you and your work. X is where I am. I always post thoughts and research. You can find that thread there that we talked about today at Sam Calla, SAMCALLAH. I also work on the news block with my wife, Natalie. It's thenewsblock.substack.com. It's just like a weekly market update. And so you can check it out there.
Highly recommend the market update and follow Sam. He's got some great insights. Sam, my man, thank you so much. You and Natalie have a great weekend.
Thank you. Appreciate it.
For all of our listeners and viewers, we'll see you all next week.